Okay, let's dive in. Today we're plunging into the world of UCC law for the living, specifically unpacking some seriously complex topics. Mortgages, foreclosure, debt validation,
Uh-huh.
UCC filings, and how all of this connects to the broader financial system.
That's right. Our mission, really, is to take this stack of sources you've provided, articles, research, notes, and, extract the most important nuggets of knowledge.
Right.
We want to empower you, the listener, with plain language, real-world examples, and the principles of commercial law that are, well, the foundation of these situations.
Think of this as your shortcut to being truly well-informed. We're aiming for those aha moments, helping you understand the system you're navigating, especially when it involves your home, without getting totally overwhelmed by legal jargon.
Exactly. It's about demystifying the process and understanding the principles at play, drawing directly from the material you've gathered.
So let's unpack this, maybe starting where many of the sources do, with a look back at the history of money lending itself. It's kind of fascinating how old the tension around lending is, right?
Oh, absolutely.
Our sources delve into the morality of money lending, showing just how long this has been debated.
Yeah, for centuries, charging interest on loans, or usury, as it was called, was often viewed with really strong moral condemnation. It faced significant legal restrictions, too.
People saw it as taking advantage.
Pretty much,
Uh,
taking advantage of someone's necessity.
But then you had thinkers starting to challenge this. People like Menelaus back in the 1500s. He began arguing that lending wasn't inherently unproductive.
Right. He observed that borrowers used the money, combined it with their own effort to generate profit.
So the money did bear fruit, so to speak, when put to work.
Exactly. And then Jeremy Bentham, centuries later, he took a more purely economic view. He argued against restrictions on interest rates, saying they actually hurt the economy. Well, by limiting capital access, especially for riskier, maybe more innovative ventures, he also pointed out that making legal loans difficult just pushed people towards illegal lenders charging even higher rates.
Okay, so what's a key takeaway from this historical view looking at these sources?
I think it's that despite those powerful economic arguments for lending, that public distrust of the financial sector of lenders, it's persisted for centuries.
Right, that historical tension, sort of moral view versus economic necessity, it still influences regulations and how people feel about finance today.
And that historical context, it helps us understand the tools and structures used in lending today, which brings us right to what a mortgage actually is.
Right. Okay, so the basics. In the simplest terms, according to, I think it was the Upsolve source, a mortgage is a legal process. It gives a lender the right to take ownership of your home if you stop making payments.
And that core idea, giving someone an interest in your property to secure a debt, that's an example of a broader legal concept.
Hmm.
A security interest. Levenfeld-Perlstein defines a security interest as an interest granted in assets, which serve as collateral, to ensure payment or performance of an obligation.
So a mortgage is basically the most common type of security interest you'll encounter as an individual, specifically one tied to real property, like your house.
Precisely. When you take out a mortgage, you're giving the bank a security interest or a lien on your home. The key parts of that agreement, as sources like Understanding Mortgage and Loan Agreements point out, are, well, the principal amount you borrow.
How much money you get.
Right. And the interest rate you'll pay on it.
And there are other related documents involved too, aren't there? Like the original purchase contract for the home, the appraisal.
Absolutely, the appraisal that determines its value. Yeah. And these mortgage agreements, they also contain crucial clauses, things that are really important to understand, like the acceleration clause.
Acceleration clause. Okay, what's
So that
that?
means if you default on a payment, the lender can demand that the entire remaining balance becomes due immediately.
Wow. Okay, so not just the missed payment, but everything.
Everything. That's how you can suddenly owe the whole amount.
And there's the due on sale clause too.
Right. That means the full balance is due if you sell the property. You can't just sell your house and, have the new buyer take over your old loan without the lender's permission.
They want their money back when the property changes hands. Makes sense.
Which leads naturally to the difficult topic of what happens if you can't make those payments.
Yeah, that's where foreclosure comes in.
Yeah.
The Upsolve source gives us a pretty clear breakdown of this process.
Foreclosure is the legal procedure the lender uses to take possession of and sell your home. It can be either judicial, meaning it goes through the court system, requires a judge's approval,
Okay.
or non-judicial, which happens outside of court based on the specific terms written into the mortgage agreement itself. Depends on the state, usually.
And it doesn't happen overnight, which is important to know.
Eh.
According to Upsolve, federal law actually requires lenders to wait until you are 120 days delinquent.
Right, 120 days.
That's typically 4 full missed monthly payments before they can even start the formal foreclosure process.
But the consequences, when it does happen, are significant. Your credit score takes a major hit. You will eventually be evicted from the home.
Uh-huh.
And you could potentially owe what's called a deficiency balance if the house sells for less than the total debt you owed.
But here's a key nugget, though, also from Upsolve. You do have rights during this process. You're entitled to proper legal notice about the foreclosure.
Absolutely. Proper notice.
And crucially, you have the right to stay in the home until the foreclosure is actually finalized. You aren't just immediately kicked out after missing a payment.
That's a really important point. And because foreclosure is costly and, frankly, time-consuming for lenders too, they often prefer to find an alternative solution.
Which brings us to strategies for defending against or avoiding foreclosure altogether.
Right. Upsolve lists several loss mitigation options. These are ways you can work directly with the lender to try and resolve the situation.
Okay, like what?
Well, options include loan modifications, where the lender might change the terms of your, the interest rate or payment amount to make it more affordable.
Okay.
There's forbearance, which is basically a temporary pause or reduction in your payments, gives you breathing room.
Uh-huh.
And repayment plans, which let you catch up on missed payments over a set period, maybe tacked on to future payments.
Selling the home before foreclosure is complete is another strategy mentioned. Either a traditional sale if the home is worth more than you owe,
Right, get your equity out.
or a short sale if it's worth less, where the lender agrees to accept a payoff amount that's less than the full debt. They take a loss, but avoid the foreclosure hassle.
Bankruptcy is also an option mentioned in the sources. Filing Chapter 7 provides a temporary automatic stay, which pauses the foreclosure.
Causes it. Okay.
But it doesn't erase the missed payments or the mortgage debt itself, usually. Chapter 13 involves a structured repayment plan over several years, including catching up on the mortgage.
But there are definite downsides to bankruptcy, right?
Sure.
Significant credit damage. For one,
Huge credit damage, and the lender can actually ask the court to lift that automatic stay, allowing the foreclosure to resume anyway, so it's not always a permanent fix.
now one of the sources, called foreclosure defense, it introduces a completely different approach. Something for challenging a foreclosure that often happens outside of the traditional court lawsuit.
Yeah, it calls this an administrative process, or sometimes a paper war.
Okay, wait, an administrative process. How does that work? It sounds, I don't know, very different from filing a court case or trying to work out a payment plan with the bank.
It is quite different. As described in the source, the core idea is to challenge the alleged debt itself, or maybe the lender's claim to that debt, through a series of formal written communications.
Okay.
And it's based on commercial law principles, specifically drawing heavily from the Uniform Commercial Code, or UCC.
Let's really dig into that debt validation process then, because that sounds like a central piece of this administrative strategy the source describes. It talks about using specific UCC provisions as tools.
Yes, this source highlights several UCC sections as being key. For instance, it mentions UCC 1308.
1308.
Right, for explicitly reserving your rights when you communicate with the other party.
Okay, so that's basically saying I'm responding, but I'm not giving up any of my legal rights just by talking to you.
Precisely. And then it points to UTC 3501 and 3505. These are the provisions that, in this strategy, are used to essentially force the other party, the alleged lender or servicer, to prove they actually own the debt and that they have the legal standing to demand payment from you.
So it's about making them show their homework, basically. Prove they are the rightful party to collect.
Exactly. Show me the proof.
Yep.
And the source also mentions UCC 1305 as giving you the right to be made whole or compensated if they make errors in handling the transaction or the process.
So the steps in this strategy, as described in the source, it involves sending a notice of tender. What's that?
The source frames it as an offer to pay the right party if they can prove they are, in fact, that right party.
Okay, so it's a conditional offer.
Right. And it's followed by a formal demand for proof that they actually own your loan. This is the core debt validation step.
And the template provided in that source for this demand, it's very specific, isn't it?
Extremely specific. It requires the other party to provide the original promissory note.
The actual IOU you signed.
Yes, the original wet ink signature note, ideally, plus the complete chain of title showing how they legally acquired ownership of that note and the mortgage, full paper trail, proof they have the legal standing to collect from you specifically, and a full accounting of all payments made and any fees charged. Complete transparency.
And according to this source, the demand letter explicitly states that if they fail to provide all of this documentation,
Yes.
it constitutes their agreement, their sort of acquiescence, that no valid debt exists that they can collect on. It also clearly reserves rights under UCC 1308 again.
That's the mechanism described in the source material, yes. It sets up a condition for their response.
So what does the source say you do if they, don't respond? Or if their response is incomplete or just like a generic letter?
Well, according to this strategy, you continue the administrative process. You don't just stop. You send a follow-up, a notice of fault.
Notice of fault?
Right, explicitly stating that they failed to validate the debt as you demanded. You give them another chance, a specific time frame, to cure that fault.
And if they still don't comply after that?
Then you send a notice of default. This asserts that they are now in default for failing to provide the requested validation. Not you, for failing to pay a debt they haven't proven they own.
Interesting flip of the script there.
It is. And finally, as part of building this paper trail, the source suggests you can create an affidavit of truth.
Your sworn statement.
Exactly. Your sworn statement documenting the entire process, detailing your demands, their failure to respond or validate, making it part of the official record from your side.
This whole administrative approach, it really seems to rely heavily on the Uniform Commercial Code, the UCC, as its foundation.
It absolutely does.
So what is the UCC, in plain language, for someone who hasn't encountered it before?
Well, the UCC is basically a standardized set of business laws. It governs commercial and financial contracts across the United States. Sources like Investopedia and Baker Donaldson note it's been adopted in some form or another by virtually every state.
Why? What's the point?
To provide uniformity in business transactions. So the rules for, say, selling goods or securing a loan are basically the same whether you're in California or New York. Makes commerce easier.
Got it. And a crucial part of the UCC for our discussion today is Article 9.
Correct. UCC Article 9 specifically governs security interests, those legal claims on collateral we talked about earlier, like the mortgage leading.
Okay.
It applies primarily to secured transactions in the commercial world, but as we're seeing, it's relevant here because mortgages, and especially the underlying promissory notes, are assets. They can be bought, sold, and used as collateral in commercial finance.
And sources like the PUB commentary clarify that Article 9 doesn't just cover granting a security interest in certain assets, but also the outright sale of certain things called specified payment rights.
That's a key point. And those payment rights, as defined by the UCC, include things like accounts receivable, chattel paper, payment intangibles, and importantly for us, promissory notes.
The very document you sign promising to repay your mortgage loan.
Exactly. That note is a payment right that can be sold under Article 9.
And to make these security interests or these sales of payment rights official and public, you often file something called a UCC-1 financing statement.
Yes. The foreclosure defense source describes the UCC-1 as the standard official way to record a claim or interest in property. It essentially creates a public notice of that lien or interest.
And where do you file that?
Typically, you file a UCC-1 with the Secretary of State for personal property, but Wolters Kluwer explains that if the collateral is considered fixtures...
Fixtures, like things attached to the house.
Right, things attached to the real property in a way that makes them legally part of the property. Think built-in cabinets, furnaces, things like that. For those, you need a special fixture filing statement.
Okay, and that's filed differently.
Yes, a fixture filing requires a description of the real property itself and the owner's name, and it has to be filed locally where the real property is located. Usually in the county land records, the same place mortgages are recorded.
Interestingly, Wolters Kluwer also points out that the mortgage document itself, when it's properly filed in those local land records, can also function as a fixture filing.
That's right. It can serve double duty to perfect the security interest in those fixtures.
So the UCC provides the legal framework, the rules of the road, and the UCC-1, or sometimes the mortgage itself for fixtures, is the public record, the official signpost establishing these interests.
Exactly. And just to circle back quickly, UCC 1308, the reserving rights provision we mentioned with the administrative process.
Yeah.
That's a tool often used within communications related to these kinds of commercial transactions governed by the UCC.
Okay. This brings us to a maybe less technical, but unfortunately very necessary topic: mortgage fraud and predatory lending. Our sources from the Riverside County DA and MEC highlight some important things to watch out for here.
Yeah, real estate fraud covers a whole range of schemes designed to cheat people during property transactions. The Riverside County DA source describes something called equity skimming.
Equity skimming.
Yeah, where criminals use a fake buyer or a straw buyer to get a mortgage. They take the cash out of the property, maybe through a refinance or a home equity loan, and then they just let it go into foreclosure, leaving the straw buyer or sometimes even the original desperate homeowner they roped in holding the bag.
Nasty stuff. They also mention real estate Ponzi schemes.
Right, which promise huge, totally unrealistic returns on investments in, say, land or property development projects. Early investors might get paid, but it's just with money from later investors.
Classic Ponzi.
Exactly. Creates the illusion of profit, but the actual underlying investments are often fake or worthless, and eventually the whole thing collapses.
What's really crucial from these sources are the warning signs.
Yeah, right.
And the protective measures people can take.
Absolutely. First and foremost, maybe the most important one, read and understand every single document before you sign it. Don't let anyone rush you.
And demand everything in writing. If someone makes a promise, get it in the contract. If it's not in writing.
It basically didn't happen, legally speaking.
Right. Also, verify the licenses and reputations of everyone involved.
Yes. Your agent, your broker, the appraiser, the lender, the escrow officer. A quick check online with state licensing boards can save you immense trouble.
And be vigilant about protecting your identity. Because identity theft can lead to fraudulent mortgages being taken out in your name without you even knowing it happened.
Scary thought. And if you do suspect real estate fraud, the Riverside County DA source provides information on how and where to report it to their office or other relevant law enforcement.
Now, the MEC source focuses specifically on predatory lending. This is where lenders target vulnerable people and communities.
Right. Sometimes through what's called reverse redlining, aggressively marketing really costly, often deceptive loan products in areas that were historically discriminated against and maybe lack access to fair credit.
And what kind of tactics do they use?
Well, things like piling on excessive fees that trap people in debt spirals. Even if the initial interest rate doesn't look too bad, the fees eat them alive. The source also mentions how lenders sometimes exploit loopholes, like these rent-a-bank schemes.
Rent-a-bank.
Yeah, where a non-bank lender partners with a bank, often one chartered in a state with very weak consumer protection laws, specifically to get around state-level interest rate caps in the borrower's home state, allows them to charge sky-high rates they couldn't otherwise.
So it's clear that understanding mortgages isn't just about your house loan in isolation. It's about how that loan connects to a much bigger, more complex financial ecosystem.
It definitely is, and it's important to distinguish terms here. While a mortgage is a security interest in real property.
The leeching on your house.
Right. That's distinct from financial securities. Levenfeld-Perlstein clarifies that securities typically represent ownership, like stocks, or a creditor relationship, like bonds, things that can be traded on markets.
But mortgages are absolutely connected to that world of securities, aren't they?
Oh, absolutely. The process of mortgage securitization, where mortgages are bundled together and sold off as investments, is huge. Housing Wire mentions that industry groups like the American Securitization Forum view this process as sound and legally binding.
And going back to the UCC for a second, that PEB commentary confirmed that Article 9 applies not just to granting a security interest in promissory notes, but also the outright sale of those notes.
Exactly. And that sale is key to how mortgages get packaged and moved into the securities market.
The Hunter Brooks source gives us a bit of a glimpse into how these loans actually move through the system. It talks about loans being sold to entities like Fannie Mae and Freddie Mac.
The GSEs, yeah.
Right.
Government-sponsored enterprises.
Right. And it also mentions how non-bank lenders, who originate a lot of mortgages these days, often rely on short-term financing from big banks called warehouse facilities, like a credit line to fund the mortgages before they sell them off.
And these relationships, whether it's lenders selling loans to the GSEs or getting that warehouse financing from banks, they involve contracts, agreements.
Okay.
And in those agreements, the lenders promise, the covenant, to comply with various rules, including consumer protection laws.
And the source notes that, in theory at least, if lenders violate these promises, these covenants, it could lead to consequences for them, like being forced by Fannie or Freddie to buy back loans that went bad because of violations. or having their warehouse lines of credit pulled by the banks.
It's important, though, as you said, we're just reporting what these sources describe about the practices and potential risks within the system. We're not validating any specific claims of fraud or violations ourselves.
Right, just showing how interconnected everything is, from the loan origination to the big financial players.
Exactly.
Okay, so let's circle back one last time to that administrative process we discussed earlier, the one from the foreclosure defense source.
Right. It's presented as a distinct path, a non-judicial administrative remedy.
Using those specific tools from commercial law and the UCC.
Yes, provisions like 1308 for reserving rights, 3501 and 3505 for demanding proof of claim, and 1305 regarding remedies.
And the process involves using those formal notices, notice of tender, demand for validation, notice of fault, notice of default.
Right, meticulously documenting the other party's response, or maybe their lack of response.
And creating your own record through things like affidavits of truth and potential UCC-1 filings, all happening outside of the standard court foreclosure lawsuit.
It's presented as a paper-based challenge, fundamentally, using principles from commercial law to question the basic right of the other party to collect the alleged debt from you in the first place.
Wow. When you take all of this in the long history of lending, the technical definitions of security interests and mortgages, the formal foreclosure process itself, these, alternative administrative strategies and UCC tools.
The unfortunately real issues of fraud and predatory lending, and then how it all connects up to the huge financial markets.
It really shows just how layered and, frankly, complex the systems governing our property, our debt, and commerce truly are.
It's a lot to wrap your head around.
It really makes you stop and consider. How does understanding these concepts, like what a security interest really means, or the idea of demanding debt validation, or even just recognizing the role of these administrative processes, how does that change your perspective the next time you look at a financial agreement or think about your own rights in a transaction?
That's a great question to ponder. There's definitely a lot packed into these topics we've covered today.
We don't teach law, we teach life.